We remember we had the wheat contract and we had the live cattle contract. Okay, and I told you how this works in principle. It's not very complicated. It's just old-fashioned measures, and the price quotations are not very intuitive. But I mean, once you have understood how it works, it's just a question of multiplying and dividing. And actually, on Bloomberg, most of the work is already done for you. So if we go again back to Bloomberg, wait a second, I think you cannot see Bloomberg now. I have to share differently. Try again. Okay, écran entier. So I'll share my full screen. Okay, and then you should be able to see the Bloomberg. Okay, so wheat. Again, we look at the next wheat contract. Okay, and we look at, actually we should first look at the security description which you have here. Okay, and you actually have most of the information that I mentioned on about the wheat contract. You have it here. Okay, so contract size 5,000 bushels. Can you see that? Let me see. No, it's all small again for some reason. Okay. Now, okay, so now we have the infinite regress, but okay, when I change it to Bloomberg, you should be able to see the Bloomberg screen. Okay, I cannot push it around. Oh, I can. Okay, so that's not too bad. Okay, so here you have the contract size, 5,000 bushels. You have the value of 1 point change in the price quote. So the price quote is where the current price is not even on that table. The current price is here. So it's something like 1,067. Okay, so the price again is in cents per bushel. Okay, and actually we found out yesterday that because it's 5,000 bushel and it's about 1,000 cents or $10 per bushel. The value of one contract is around $50,000, and that's what you have here. And that means that a 1 point increase, so it goes from 11,000, what is it, 10,067 to 10,068, that is a $50 change in the value of the contract. Okay, a tick is the quotation. You can see that it's quoted in up to quarter of a cent. Okay, so it's in cents and quarters of a cent. Again, very old-fashioned. But here we have 1,069.5 cents. So the tick size is 1/4 of a cent, and that would correspond to 1/4 of $50. $50 is 1 cent exchange increase. So that's $12.5. Okay. Here you have the price. Here it is, the price. Okay, that's a mistake. Okay, it's US dollar per bushel, but it's not $1 per bushel. I think it is $10 per bushel, because if you multiply $1 per bushel with 5,000 bushels, you don't get $50,000. Okay, but Bloomberg is always making all kinds of mistakes, so that's not surprising. Okay. And then what else do we have? That's more or less the information we have on this first descriptive page. So this is the delivery date for this contract. So this is the May 2022 contract. So that's the next contract. So you have to deliver between the 2nd of May and this 17th of May. If you carry the contract up to maturity, we will have to discuss about this in a minute. And then here you have the margin requirements. So the initial margin and the maintenance margin. We will talk about this in a minute. So interestingly, it's different for speculators. So for companies that do not use wheat but just buy the futures, and for companies hedgers, so for producers or users of wheat. Okay, so let's go back to the class and see. Here we go. Okay. So that's more or less the same thing that I've here. I just try to explain how you can find the information on Bloomberg. That's the same thing for cattle. And then I just wanted to give you some overview of the, so that is new material that is not on the slides you have for the moment. I will upload these adjusted slides for you, okay? So that's just a little idea of the trading volume. So actually commodity trading is going up quite a bit. And you can see that it's actually going up quite a bit, mostly because of the Asian increase, okay? So there's a lot of commodity trading in Asia now, and actually the biggest commodity trade exchanges are all China nowadays, Chinese nowadays. So North America and Europe, the trading doesn't really, I mean, it increases a little bit, but the real growth comes from the Asian markets, and that's the Chinese market. You can also see that, maybe we can increase this a little bit. You can also see that the most important, so this is actually, if you look globally, the most important commodities that are being traded are financial. I mean, the most important future contracts are financial futures. And in terms of commodities, you can see that the most important commodity future contracts are energy future contracts, and then you have precious metal, non-precious metal. So precious metal is the very small part here. This is industrial metals or non-precious metal, and you have a bit of agriculture. So, but the biggest part of the commodity market is actually energy. Here, just an example, some important contracts. So these are the important contracts in precious metal. So you can see silver, gold, and apparently diamond futures. I didn't know that existed, but apparently there is a lot of trading in diamond futures. Okay, so gold futures, silver futures, and diamond futures. Interesting. These are the industrial metals. Okay, so iron ore, aluminium, and copper and zinc. So these are the biggest contracts. There are more contracts, but these are the most important contracts that are traded. You have this is a trading in terms of number of contracts. But this is not really informative because contracts can have very different values. So we have seen that these agricultural contracts have values around $20,000 to $50,000, but the precious metal contracts can have quite different values. So here is the agricultural commodities. So the important ones are corn, wheat, and soybean. Okay, so this is the CBOT. That's the big US exchange. And these are two Chinese exchanges. And you can see that indeed soybean is also important, but they also have palm oil and corn futures here, and rapeseed, and sugar and cotton futures. Okay. And you can see that these contracts are a little bit more rationally organized because one contract is for 10 tons and not for, bushels. Anyhow. And finally, the energy contracts. So gas and oil are the biggest contracts, but then you have very different types of oil. So Brent is the oil quality that you can get on the North Sea. Light sweet crude oil. I don't know exactly what light sweet crude oil is or where it comes from. But these are different qualities of oil that are used to produce gasoline or airplane fuel and so on. Henry Hub is a very big crossing point of different gas pipelines in the US, and that's where you have to deliver your gas if you're buying or selling gas. I mean, gas is pretty difficult to transport, so the physical location of the gas delivery is important, and Henry Hub is one of the most important meeting points for gas pipelines. Okay, so that's a bit the overview, and let's maybe start to use WooClub now, okay, and do some very stupid, simple exercises. It's gonna get a little bit more complicated over time, but for the moment, I just want you to go to WooClub. So you type, so open another browser window and you type this address, okay? And when you type this address, you should see, let me show you what you should see. You should, no, I haven't done it yet, okay. I'm gonna go there. No, maybe we should close. No, I can close that. Okay, so you should see this this screen. Okay, so actually I will have to access a different screen because I'm the one who is managing this WooClub. So I will go there and I will open this WooClub questions for you. Okay, so here's what you should now see. Okay, apparently 3 of you are already registered. Okay, so let me check again if I can maybe. Okay, progress. Okay, well, let's start here. Okay. Okay, it seems to work. Okay, so here with the questions, and normally you should be able to enter an answer directly on your computer. Okay, for the moment I seem to have 4 people that are logged in, but nobody has answered so far. Okay, so what is the question? So we are a user of wheat. We are a bakery, industrial bakery, and we are worried that wheat prices will go up. So we want to lock in a certain price of wheat for oh, that should be 22. I changed that. Okay, so this is not September 21, this is September 22. And I want about 550 tons of wheat for September 22. So the first question is, do I have to buy or sell a wheat future? Okay. So it's actually I think you can see the results now. No, you cannot. Okay, so that's good. So buy or sell. Only 2 people are listening apparently to what I'm saying here, so that's quite encouraging. You want me to paste the link? Yes, I can do that. But it's pretty straightforward. It's just yep. Here you go. Okay, so I have to go back to the WooClub. Now it's now everybody's logging in. Very good. Okay. So actually, I can use this as part of your grade. It's very convenient. If there's good participation, we can have a big part of the grade from the WooClubs. Okay. 14 logged in, and only 6 replies so far. Not terribly encouraging. Let me see How many are logged in here? 31. So I think some of you are having dinner right now. Okay. Good. Okay. So 16 logged in, 10 replies. I think that's about as good as it's going to get. Okay. I hope you entered your name, otherwise I cannot see who you are and I cannot give you a good grade for participation. So, yes, I have to buy a futures contract. Okay, I have to buy wheat in the future, so I have to buy. I'm long in the wheat contract. Okay. Now, same question. Okay. So one contract is, as we know, for 500 bushels, and 500 bushels are 136 tons. So how many contracts do I need to buy? You can round. I'm not sure you need a calculator for that. It's not so complicated. It should be not too complicated. Okay. So how many contracts of wheat do I need to buy to hedge or to lock in the price of 550 tons? Have to be a bit of a calculation here. So, I mean, the interesting question, that's going to be the next question, I'm pretty sure. Okay, 9. Shall we go for 10 replies? 10. We have the 10th reply. 11. Wow. Okay. Okay, I stop the voting. Okay, and then let's check. Yes, 4.04. So 4 contracts would probably be appropriate. So you have a little bit of residual risk here. But if you divide 550 over 136, you get 4.04. You get almost exactly 4 contracts. So the correct thing to do is here to buy 4 contracts of wheat with a delivery in September 2020. 22. So what is the appropriate price that we can log in? Okay, so now I have to show you again the wheat page in Bloomberg. Okay, and we will go to, so we said we need the September contract. Okay, so let me see if I can get, so this is the May contract. So this is not the one we are interested in. We are interested in the September contract. So I have to look at, okay, so this is the September contract. Okay, and I cannot find the, okay, so that's, here you have the price for the September contract. Okay, so we will have to talk about this curve. This is the futures curve. It gives us the different prices for delivery in different moments in the future. So the price we have seen before was the May contract, and the May contract is the nearby contract. So this is 522. So that's the price we have seen. Remember, it was 1066.67. But now we want, you can see it changes all the time. Okay, now we want to have a wheat a little later. We want it in September. So actually, the price for delivery in September is this one. Yes, September 22. And you can see that you can buy wheat up to 2 years in the future. And you can also see that if you want wheat only in 2024, the price is actually quite low. Why? Because everybody thinks that in 2 years this war problem is over. and that we will be able to buy again wheat from Ukraine. So this contract is but apparently in September, and even for next year, a lot of traders anticipate still problems with the wheat. Okay, so let me check again with WooClub. Check how things look. Okay. Yes. Okay. So what is the appropriate price that we can lock in for this delivery in September? 21 locked in. Very good. Yes. Okay. No, interesting. So now we have different numbers. Okay. I think that's the one. No, 994. Let's check again the Bloomberg page. Okay. I said this is the one that we are in. No, that's no. This is the one we're interested in. 998, 994. The September contract. Okay. Actually, I may have clicked on the wrong contract. Okay. This is the August contract, and this is the September contract. So it's 995, 994 around these prices. Okay, very good. 1082. That's the nearby. This is the May contract. Okay, from last time. Okay. So how much do we have to pay in March now? Okay, for our 4 contracts. How much does it cost to buy these 4 contracts? And I should warn you, this is a trick question. Okay. How much do we have to pay now for the 4 contracts? And please don't hesitate to, ask questions. Best over mic. You can see that I don't see. I mean, I can go back, but it's complicated for me to see your messages. So it's better to switch on your mic and just ask a question. Okay. How much we have to pay in May? Trick questions. Warning. Okay. Shall we block you? Nobody dares answering. Let's block you. Interesting. 0 is the correct answer. Okay. 0 is the correct answer. Why? Remember, a futures contract is a contract where you conclude a deal today, but you buy and deliver in the future. Okay. So at the moment of the delivery, okay, you don't have to pay a price. Actually, you have to give some money to the futures exchange, but this money you will get back. Okay, so this is the margin, and this is something we'll have to talk about now. But in terms of price, the contract has a price of 0. You can just go there and conclude a contract. But of course, once you have concluded the contract, you are committed to pay the price you have calculated here, the 3,980, this is obviously, this is 4 times the futures price that you have locked in. This is the price you will have to pay, but you will have to pay it in September only upon delivery, not in March. So the sometimes surprising fact is that the entering or buying a future contract doesn't cost anything at the moment when you enter the contract. Okay, because again, it's a contract for future delivery and future payment, but it's a binding contract, so you cannot get out of it, despite the fact that for the moment you haven't paid anything. Okay. Let me see. Okay. Now, so the price drops tomorrow to 620. Okay, so that's a big price drop. This is a big price drop, because that's with last year's prices. But let's just assume that this is the price drop, okay? So it goes down from 900, what was it, 950 or something, to 620. And you have bought futures contracts, remember, for wheat, okay? So what is going to happen for you? Are you going to lose or are you going to win? Money. You haven't put any money down so far, but you know that you will have to pay money in September. Now you're replying. Very good. Wow, so many replies. Okay, let me see. You are losing money indeed. Okay, the price goes down. You are long. You are losing money. Why are you losing money? You are losing money because you have accepted to pay 950 for wheat in September. Now, if the price drops tomorrow to 620, you could have bought the same wheat that is delivered in September but for a price of only 620 in September. Okay, so actually you have lost this entire difference. You are committed to pay 950, but actually now the price for delivery in September is 620. Okay, and that's of course what's going to happen if the war suddenly stops, and we know that there will be lots of wheat being planted in Ukraine. The price will drop very radically, and then people who have locked in, who have bought futures contracts for wheat, they will lose money. They will lose money because they lose money in terms of opportunity cost. They have lost the opportunity to buy it at a cheaper price. Okay. And of course, the people have sold this wheat. So these are people that are short in the wheat futures. They will make money because now they have locked in a price of 950, and actually the price today is much lower. But they can get this price from you because they have locked this in. Okay. How much money will you lose on one contract? So that's going to be a complicated calculation, okay? Because the price drop that I've assumed here is a lot. So let me maybe help you out here, because this is going to be a little bit complicated. Okay, so which price are we going to assume here? Okay, so we said September 22. Let's just assume that the price is September 22 price is 1,000. Okay, so that we locked in a price of 1,000, and now the price is 620. Okay, which means that the contract dropped by 380 points. Okay, but remember that this is expressed in terms of pence per bushel. Okay, and that actually, if we have bought one contract, we have committed to buy 5,000 of these bushels. Okay, so on every bushel we lose 380. On 5,000 bushels we are losing. Well, let me see what your opinion is here. Okay, on the 5,000 bushels, we use all kinds of money. Now I think nobody got it right. Okay, let me. I need Excel for that. Okay, I'm not a good calculator, but if we go back to the Bloomberg page here, okay, remember that 1 point, okay, 1 price point is a value change of the contract of 50. Okay, because it's 5,000 bushels, so 1 cent per bushel change, you multiply it by 5,000 cents. That's $50. Okay. Yes. So if you have a price change of 380 points, okay, we have to multiply it with 50. Okay, and that's what my Excel is going to tell you. Okay, so that's 380 points. 380 times 50. Okay, where's my, okay, $19,000. Okay, so we lose on one contract $19,000. Okay, we lose 380 pence per bushel, but we have committed to buy 5,000 bushels, and that adds up to, or multiplies to $19,000. Okay. Okay, so that's just a very simple example of how futures can be used in an industrial context by a company that needs to make sure that some input material is available in the future for a stable price. And it's, I mean, you can see how you can generalize this idea to many other examples. Okay, if you, I don't know, if you are a car producer, you want to lock in prices for steel. If you're electricity producer, you want to lock in price for energy. You can use this idea in a lot of contexts. And obviously, you can also lock in prices if you are a seller. So if that's actually often the more relevant part. So, for example, if you are a farmer, you have to take out a loan today. You have to buy fertilizers, to buy a new tractor, to buy seeds. What do I know? Okay, and if the prices are fluctuating a lot, you may not be able to, we may not be sure that you will be able to reimburse your loan. Okay. Now, given that you can lock in a very high price today, you know that even if in the future the prices crash, that doesn't matter. You can lock in. Lock in the price, and you know exactly how much you will make from the wheat, even if the wheat hasn't yet been planted. You can already anticipate that you will be able to make a high return on this yield because you already have locked in a price, and whatever happens to the future prices, you don't care about. And that's, of course, quite convenient. It means that now a lot of people will start to plant wheat. They don't have to think about, they don't have to think about Ukraine and what is Russia's idea and what do we have to, will Putin agree on stopping the war or not stopping the war, or how much, you don't care, okay? You don't care. You just realize that if you plant wheat now, okay, you will probably, harvest in August and sell in September. So if you plant wheat now, you will be able to get a price of 1,000 cents, $10 per bushel, okay? And that's the only information you need, okay? So you sell wheat in the future and you plant accordingly. And then your financial return will be totally indifferent from whatever happens in the Ukraine, what happens to climate, anything, okay? Anything that happens to the wheat price once you have locked in this wheat price is irrelevant for you, okay? Of course, what cannot happen, what should not happen is that you cannot produce the wheat. So if your field burns down, for example, or I don't know, or you have some pest that destroys your crop, then you are in trouble because you have committed to sell wheat at a price of 1,000, and if you don't have the wheat, then but you will have to deliver anyhow. So that is maybe a problem, but that you can solve this issue with insurance. Insurance will not, your fire insurance or crop insurance. That's possible. You cannot insure the future wheat price because insurance companies don't insure price movements or rarely insure price movements, but you can insure against agricultural risks such as fire or pests. So I mean, you can see that this is a really good mechanism that makes it easy to increase the supply, in particular of agricultural commodities. As soon as there is some problem, these problems will be anticipated in the futures prices. Okay, a lot of traders will think about what will be the price in the future, and this will drive up the price. And then the farmers themselves, they don't have to do all this work. They don't have to think about what will happen to prices in the future. They can just rely on the futures prices and make their decisions. Okay, so that's our first little WooClub exercise. Okay, we have 25 members now logged in, so that's not too bad. I hope you are not logged in several times because I think it can happen. Okay, I will look in the break. In the break, I will look at what you have done and if you have logged in correctly. And if I can identify your names, because that's of course interesting. Okay, good. Let's move on. Let's move on after this little exercise. Okay. Now we have to go into more details about the technicalities of these future trades. Okay, and in particular, we have to talk about clearinghouses. So the clearinghouse is what? The clearinghouse is this part of the future exchange that makes it sure that you will not default and that your counterparty will not default. If you again compare a forward transaction to a futures transaction, the difference is quite simple. In a forward transaction, you have the buyer directly negotiating with the seller, and whenever one of these parties, defaults, doesn't deliver or doesn't pay, then the risk is directly for the other party. If you are trading on a futures exchange, you have the clearinghouse that gets in between the seller and the buyer, and the clearinghouse keeps enough money to make sure that if the seller defaults, the buyer can still get his money. Okay, so again, this makes it much simpler to trade for the different market participants. So, I mean, if you want to trade on, the evolution of the wheat price, and you want to do this with forward contracts, you don't have to think about what is, the credit risk of the seller of the contract, or what is the credit risk of the buyer of the contract. This information is difficult to obtain, and this would make it difficult, to speculate or to trade on wheat. In the system with futures contracts, you don't need to know how honest or how wealthy or how high levered, how risky your counterparty is. That is going to be taken care of by the clearinghouse. Okay, so how does the clearinghouse make sure that that nobody defaults here? The mechanism is margin requirement and a daily settlement. Okay, so what does it mean? The margin is the amount of money that you have to deposit when you buy a future contract. Okay, so just before I told you that it doesn't cost you anything to buy a future contract, and that's strictly speaking true, but of course it doesn't mean that you don't have to deposit any money in the margin account. So actually you have to pay something, but you have to just pay a safety deposit, so that if you lose money, the futures clearinghouse can take this money and can use it to pay the other counterparty. Okay, and that's the margin. Okay, so you have to deposit some money in an account at the clearinghouse, but that money is not the price you're paying for the futures contract. It's just a safety deposit. Okay, so that's the first thing. Okay, so you have to deposit some money, and then the second mechanism is this daily settlement mechanism. Okay, so what is this daily settlement mechanism? This is similar to what we've just done. So we have just figured out how much did I gain or lose given that the futures prices have changed. Okay, now the clearinghouse will look at how much will calculate this gain or loss at the end of each day. Okay, and then it will just take, if you have lost money, it will take this money out of your margin, and if you have gained money, it will add back this money to your margin. Okay, so they will just remove or add any losses or gains to your margin account. Okay, and that by requiring a margin that is sufficiently large compared to what is the normal price movement in a given day, they can make sure that normally you do not default on your contract, because normally prices don't move a lot in a given day. And if you do some statistics about price movements, and we have to talk about this, but if you do some statistics about what is the, the likeliest, what is the highest price movement that we can get, you can calculate how much is the margin that you have to deposit, so that normally, okay, with very high probability, any loss that will occur over one day is covered by the margin. Okay. Now, of course, we discussed these nickel contracts yesterday, And one of the problems that happened with this nickel contract is indeed that the prices moved so much and so quickly that actually all of these margin contracts were empty immediately. And then the problem was that the investors didn't have enough money to fill up these margin contracts again. Okay, but before we go to that, let's look at the mechanism in detail. Again, with the very simple mechanism. So how does this margin mechanism and daily settle mechanism work in detail? You have three types of margins. You have the initial margin, and that's what you have to deposit in the clearinghouse when you buy or sell. Even if you sell a futures contract, you also have to deposit a margin. That already tells you that this is not the price. So whenever you enter a future contract, buy or sell, you have to deposit this initial margin. Okay. Now, you do not have to immediately put money back if you lose money. Okay, if you lose on your futures contract. Okay, actually, what happens is that you have a so-called maintenance margin. Okay, so again, every day the future contract will, the clearinghouse will put money into your account or take out money from your account. Okay, now if you're losing money over a series of days, at some point the remaining margin in the account will fall below this maintenance margin. Okay, and then you have to replenish again, and then you have to add some money, and that the money that you have to add, okay, once you have hit this lowest possible threshold, the maintenance margin, that's called the variation margin. Okay, so let's do a little exercise to illustrate this in a simple way. Okay, so we have an oat contract now. Okay, so the oat contract is okay. I think it's also for 5,000 bushels. Okay, but anyhow, okay. One tick, yes, one tick in the oat contract. It's the same construction as the wheat contract. Okay, so it's 5,000 bushels, and it's in cents per bushel. It's just much cheaper than wheat, as you can see. Okay, now that means that one tick, okay, 1 cent price change is a $50 value change of the contract. Okay. Now let's suppose we are buying a contract. Okay, today, day zero, and the price today is 171 cents per bushel. Okay. So because we have entered the futures contract, we have to deposit the margin, and here the initial margin is $1,400. Okay. Now the maintenance margin, so that's the minimum level, is $1,100. Now let's suppose that, so at the first day we just put down this $1,400, and we entered in this future contract with a price of 171. Now the contract, the price decreases. Okay, so at the end of day 2, the price is decreasing from 171 to 168. So we have a 3-cent price decrease. We know that 1 cent is $50, so 3 cents is $150. Okay, so that means that we are losing $150, and this money will be taken out of my margin. Okay, so the initial margin, remember, yesterday was 1,400. We're losing 150. So what is left now is the new margin, 1,250. Now the new margin is still higher than the maintenance margin, so we can just leave it there. We don't have to do anything. Now, if on the second day the prices continue to decrease, so here they decrease by 4 cents, I will lose another $200 on my contract. Okay, which means that now I only have $1,050 in the margin account, and that's lower than the maintenance margin. So now I have to put back some money, and I will have to add back a variation margin. So in this case, the variation margin is 350, so that you are getting up to the initial margin again. Not always the case. Sometimes you have to put in less. So these rules are quite complicated, but I mean that's not really important. I mean, what's important is to understand that every day you calculate the losses or gains that you make, and every day these losses and gains are added and subtracted from your margin. If you fall below the maintenance margin, you have to put in more margin money. If you don't do that, if you don't put in more margins, the clearinghouse will cancel your contract. They will sell your contract. Okay, so they will exit your, and you don't have any hedge anymore. Okay, they will basically realize your losses and you're out. So graphically, this is how it looks. Okay, so you have the price. Remember, you had a margin of 1,400. The price goes down. The margin falls below 1,100, but we will get what's called a margin call. So we will get an email probably or a call from the clearinghouse and says, okay, guys, you don't have enough money anymore. You have to put back the variation margin. Okay, so you put back the variation margin and you get up to 1,400 again. Okay, then same thing happens. Okay, so in this case now the price goes up, so you are making money. Okay, and actually, if you want, you can take this out. Don't need to, but you can take this and you can basically already realize your gains. But now the price goes down again, your margin is gonna empty again, okay, and here it hits again the maintenance margin, and again you have to put back some money, okay. So the guy would have received 2 margin calls here every time when the margin drops below this maintenance margin. Okay, now that's the basic idea. Now, if you read the articles, I've tried to find out exactly what happened with this nickel deal. If you read this, okay, an important thing to understand what happened with this nickel scandal is that normally you cannot, as a company or as a retail investor, directly invest with the clearinghouse. Okay, actually, only registered brokers will have access to these margin accounts at the clearinghouse. Okay, because it would be too complicated to have thousands, or maybe also because, I mean, they want to have some monopoly or oligopoly. I don't know. Okay, but the rule is that not everybody can directly get a margin in that clearinghouse. Okay, only a number of registered brokers. So they're called clearing members here. Okay, now which means what? It means that actually you as a trader, you will deposit your margin with the broker, and the broker will then invest it in your clearinghouse. Okay, now the problem is that if some crazy guy used your broker and lost tons of money, okay, the margin call will go from the clearinghouse to the broker. Okay, now the broker will get every money he has and try to invest it in the margin. Okay, but at some point the broker may not have any money anymore, and then the broker will go bankrupt. Okay, which means what? It means that you will lose your margin. Okay, because somebody else has made stupid trades with the same broker. And that's apparently the reason for why they canceled all these trades in this nickel scandal, because a pretty large number of these brokers that work with the London Metal Exchange would have gone bankrupt if these trades had been carried out. Okay, so that's the the story here on the margin requirements. So these margins are extremely important to make sure that the system remains safe, but there is always fighting about the margins, because of course the traders don't want to put any money there. I mean, the money is remunerated at the risk-free rate, so it's not totally lost. But of course, all these traders are financially constrained, and they would like to, minimize the amount of money they put there. And of course, the clearinghouse and the regulators, they always want to make sure that there is no default risk, and therefore they will try to, push for higher margins. And as we can see from this nickel price scandal. I mean, in a lot of circumstances, it is not very reasonable, let's say. Okay, let's again look at the nickel prices, because they started trading again and then they stopped it again. So it's, the whole thing is getting, the story is getting longer and more complicated. 3 months, March, this is the one we have to look at. Line chart. Yeah, okay. You can see that if you look at the variations of the nickel prices and you try to calculate, what is the probability of losing a certain amount of money in a given day, you can see that the margin requirements will not very high, because the market is really stable, at least historically, and it seems that if it's unlikely that there will be massive price movements, and in this kind of situation, of course, the clearinghouse will not require a lot of margin. Okay. Now you can see that, you can also see that the price evolution is relatively stable. It's always going a little bit up and down. It's a random walk, but you can have moments when the entire situation totally changes. And then, of course, your entire margin, the way you determine the amount of money you have to put there, stops to make sense. And then you can, of course, have default of futures exchanges, of buyers or sellers of futures contracts, despite this, margin accounts, and despite this daily settlement mechanisms. So the system is not perfect. That's what I want to say. But it's definitely much better than just dealing with somebody who don't really know, and who might default whenever he feels that he doesn't want to pay. Okay. Now, I think I have a little margin calculation example as well. Shall we go back to VooClub? But now I think we have to. It needs to be CFVG2. Okay. So let's try the margin calculations. Okay. So I'll exit this one. And I'll enter the next one. Yes. Okay. So this is CFVG2. Same name. I can paste it again if you want. Oh. There you go. Okay, so I have to start it. It's already started. Oh, already 15. Oh, I think these are. Did I empty the? I may not have emptied. Let me check something. I think you have to. Okay, you may have to log in again, but I will reset. Okay. What's okay? I think that's okay. I'm sorry. Okay, so please try again, because if you had logged in already, I threw you out. But I think very good. A lot of you are back in immediately. Good. Now we can have the first question. Okay. So if we want to deal in wheat, the initial margin on the CBIT, Chicago Board of Trade, is $3,375. It's a stupid question. So now I have, remember, as the industrial bakery, I've bought 4 contracts. How much do I have to deposit in my margin account? And you need a calculator probably for that. I need a calculator for that, but it's not a complicated question. Okay, 60% response. Let's go to 10. 2/3 response rate. That's not too bad. Yes, 1,350, I guess, is the answer. So that's just 4 times the margin requirement. Okay. Some of you have got a rounding problem here, but we bought 4 contracts, so that's around 12,000. 3 times 4 is 12,000, and then okay, so it's about $13,000 we have to put down initially to make sure that we can, okay, so now the money is a little bit okay. So I think okay, let me see. So it's December now. It's December wheat, and before it was September wheat. So I should have redone these. I should have redone these calculations. Let's just assume. So again, we were buying. We said we were buying at. Let's go back to the wheat futures. Okay, we were buying at 1,000. Let's suppose we were buying at 1,000, and let's suppose that the next day. So you already did the calculations. Okay, if you buy a 1,000 and then it goes down to 862, that's gonna be a lot of money. That's gonna be subtracted from our margin account. Okay. Again, the calculations are quite simple once you have understood that every cent in price change corresponds to a $50 value change. So actually, what we have here is what we have 158 in 48. Sorry, 38. Sorry. 148, 38 in hence price change times 50. Okay, let me see what you've got. Okay, I should have cleaned up my old WU clubs here. Let me block you off because I'm not sure you're okay. So lots of different answers. I guess I have to do the math myself. Okay, so what's the idea? The idea is that we have bought at 1,000. Okay. And we have then on the next day, the prices have decreased to, I said, 862. Okay. So the price drop is 138. And then this price drop, okay, needs to be multiplied with $50 to have the value change on one contract. And then we have 4 contracts, remember, okay? So actually for our 4 contracts, we have to deposit 27,600. Our losses will be $27,600. Okay. How much margin did we initially invest? Yes. So actually, our losses are, far exceeding the margin that we have invested. Okay. So that's an example of a situation where the margin is actually wiped out. Okay. So we would immediately get a margin call, and the clearinghouse would ask us to immediately put back money here. So, unless and if we don't do that, they will just close out our positions. Okay, I'm not sure how you calculated your numbers. Okay, let me see. Okay, maybe you didn't use the 138 price drop. No, but the numbers I gave were not very logical. So because again, these are the prices from last year. So this is not a realistic price drop in one day from 1,862. I mean, it can happen. It can happen. It happened for nickel, but it's really quite unlikely. So so do you have to re-inject additional variation margin? But in our example, obviously, because actually our entire margin is wiped out. Okay. Remember that our margin was $13,000, and now we have made $27,000 of losses. So our margin is completely wiped out, and we have to actually put in. First of all, we have to compensate these $20,000 in losses, and then we have to put in again. We we have to put in again our initial margin. So we have to invest 27,000 plus 13,000, okay, something like $40,000. We not invest, we have to inject something like $40,000 of additional margin requirement. And that is, of course, complicated for a lot of dealers. So if you have these massive price changes, then sometimes you will have problem coming up with the amount with the appropriate margin. So here's basically the calculation that I already did. So how much margin do we have to inject? So as I said, it's in the order of magnitude of $40,000. And that's why actually the London Metal Exchange, they just stopped everything. Okay, they just stopped the entire trading. Why? In order to give the traders time to find the money. Okay, because they don't have $40,000 on their bank account. They have invested it somewhere, so they probably have to sell some bonds, sell some shares. Okay, and all of this takes time. So the margin, you have to send it over immediately. So that's why the nickel trading in London was stopped, I think, for a week, so that the traders could talk to investors and say, okay, fundamentally my position is sound, but I have to invest this margin. Can you help me out, and so on. So it seems, however, that didn't work. So it seems that actually when they opened the trading again after 1 week, the prices got immediately crazy again. So they had to stop trading immediately again afterwards. And actually, I haven't found out. I think that's where we are now. I think trading is again stopped. But the situation is pretty chaotic. The problem is you have two things going on. You have a fundamental shock. So you have indeed a reduction in the nickel supply because of Russia again. But then you have these investors that had actually speculated on a decrease in nickel prices that got caught by this increase in nickel prices. And then they had to inject additional margin. If you cannot inject additional margin and you have a short contract, but then you have to buy a contract to offset it, and that's going to drive up the prices even more. Then you get in these vicious circles. Okay, but I'm getting ahead of myself. Before understanding all of that, we have to discuss about how to close a futures position. So opening a futures position is simple. You just buy a contract. What's maybe not obvious for everyone is that if we buy a contract, the contract didn't exist before. Okay, so buying a contract means actually that an additional contract will be created. Okay, so and the number of contracts that have been created is called the open interest. Okay, so let's go to Bloomberg again to see this. So if we go to futures contract table, okay, we have here the different contracts. Wheat, we are back in the wheat market. Okay. So we have May, July, September, December, and so on. Okay. For every one of these contracts, we have a bid and an ask. Okay, so that's the price at which you can sell a contract. That's the bid, and it's always, the cheaper one is the one at which you can sell, and the more expensive one is the one at which you can buy. Makes sense, no? So if you want to buy wheat for May 22, so you have to pay $1,058. And if you want to lock in a price for selling wheat, you have to you can lock in a price of $1,056. Okay, and actually this is changing all the time. So you can see that that the prices move. Maybe the American markets are closed now, so there's not a lot of movement here. But then you can see here the number of contracts that are currently outstanding. Okay, this is the number of contracts that have been traded today. Okay, and that's the contracts that are outstanding. What you can see is that the most popular contract is, of course, the May 22 contract. So what is that? There's 129,000 contracts outstanding. Okay. Remember, every contract has a value of $50,000. So there's a lot of money invested here. Okay. Shall we do the math? Okay. We do the math. 129,000 times 50,000. So that's let me check. Okay, so that's 6 billion. That's 6 billion of wheat contracts that are outstanding. So I mean, you can see the losses and gains that will be realized if wheat prices go up and down. So that, but you can see that, for example, the July contract, so the next delivery date is already there's a much smaller number, and that's the further you go out, the smaller the number of contracts. So if you want to buy wheat today, in 2 years from now, there's only 18 contracts that have been transacted. Okay, and actually there's not even a price being quoted. Because there's so few people interested in buying wheat for May 24 today. July 24, there is some prices, so there's 172 contracts. You can see that the bid-ask spread is very, very high. I mean, if you want to lock in a price of buying, you have to pay much more than if you want to lock in a price for selling. Okay, but if I go there and I buy, actually I can do that. I shouldn't do that, but normally I can open a ticket here. Okay, I probably shouldn't do that. Again, this doesn't seem to work. Okay, so I can if I want to buy a wheat contract, what's going to happen is that a July 24 wheat contract, what's going to happen is that the open interest will increase by 1. Okay, an additional contract will be created. This means that somebody is willing to create a contract with me. So this is again the prices which this guy is willing to buy in July 24. So he's offering me a contract where I can sell at that price. Okay, and if I'm interested in selling at this price and know that this guy is interested in buying at this price, I click on this thing. Okay, I cannot do this here. Right click for additional options. Okay, that's what I just did already. Okay. Anyhow, buy ticket. Here we go. Okay. Here. Okay. Here I can have ECP buy wheat. No, it's me. Sorry. Okay, I will not click here. Otherwise, I have to pay a lot of money. $35,000. No, that's not. That's the value of the contract. Okay, that's not what I have to pay now, but I have to put down margin and everything. Okay, here I can. Okay, PID electronic. Okay, so that's if I click on this thing, I will close it immediately. If I click on this thing, I would be entering in a contract, and this would create a new contract, okay, with whoever is willing to be on the other side of the deal. Okay, so this is the what is going on here? No, this is the nickel contract. So I'm lost here in my own Bloomberg things. Okay, futures contract. This was the interesting one. Okay, yeah. Yeah, here we are back. Okay, so for every transaction, if I buy a new one, a new contract will be created. And the more people are interested in trading in a certain delivery date, the more open interest will be outstanding. Okay, that's the first thing to understand. So we don't. I mean, it's quite surprising because the futures are created as needed. So we don't trade in anything specific. We just trade in a contract, and whenever somebody wants to trade, and we have two people that want to trade, but we create a new contract, and then we can trade on this new contract. It's quite fun. I mean, it's a funny idea. Now, so that's how trades are entered. Now the question is, how do we exit a trade? Now, of course, in principle, it's always possible to carry the trade, carry the contract to the delivery date, and then by deliver or take delivery. I mean, that's what we discussed when we looked at these conditions. So, I mean, remember, if you pay a live cattle contract, you have to either deliver live cattle to this stockyard, or you have to, if you sell live cattle, you have to deliver them, or when you buy, you have to take them off there. But actually, it turns out that most people that deal in future contracts don't deliver. Okay, a very small fraction only of the contracts are delivered, and the vast majority is actually cancelled by an offsetting trade. Okay, so what does it mean? It means that just before let's assume I have a contract where I'm supposed to sell wheat. Okay, I'm supposed to sell wheat, so I have a certain price at which I am supposed to sell wheat at a certain time in a certain location. Okay, as if I'm an investment bank who's speculating in wheat, I don't want to do that. I don't want to go there and deliver wheat. Okay, so what can I do to avoid going there? But what I can do is I can buy a future contract on the same delivery and on the same date. Okay, and then I have a sales contract and I have a buy contract. Right? Okay, so I have a contract where I have to deliver wheat and I have a contract where I have to take out wheat. Okay, so I take my two contracts and I go to the clearinghouse and I say, okay, I have two offsetting contracts. I have one where I need to deliver a quantity, one where I have to take delivery of a quantity. We can just, tear up these two contracts, and it's not going to change anything. Okay, and that's the majority of the futures trades will be exited in this way. So here you have a statistic that shows you. It's a bit old, but it shows you what is the percentage of the trades of contracts that are settled in cash or delivered. Okay, settled in cash means what? It means it's similar to delivery in the sense that you don't. So you have your futures. Let's suppose you are supposed to deliver wheat in a certain location in Chicago. Okay, so because you have carried your futures contract until the end. Okay, so somebody else will want to buy the wheat, okay, but actually you don't want to deliver the wheat. Okay, so what you can do is you can just pay money to the guy who wants to take your wheat, okay, so that he can buy the wheat from somebody else. Okay? That's the cash settlement. So you take it until delivery, and then instead of delivering, you pay whatever you need to pay for not having to deliver. But I mean, that's basically it's identical to financially identical to delivery. Yeah. So but the interesting thing is that for most of these contracts, less than 1% of these contracts are carried until the maturity. So are expire and then have either delivery or cash settlement. The 99% of the contracts are actually offset by a contract in the opposing direction with before it they actually arrive at delivery. And that's the so here you have it's a stupid example. I mean, it would be obvious. I've just explained it. So if you bought, so this is what, again, it's oats. Okay, so you bought again oat contracts at 171 cents per bushel. Okay, delivery in September. Okay, 22 sold the same contract. Okay, and now you want to get out of this contract, so you just sell the same contract. Okay. And now you have two contracts, okay, that have exactly the opposite direction, you just cancel them out. Okay, so I think, I mean, it's pretty obvious. I think the example is probably more complicated than the story. Okay, but that's something you have to understand. Okay, the vast majority of future contracts are never executed. There's never any delivery because they are actually offset by an opposing trade just before. And actually, that's something you see, and I don't have the numbers here, but in another slide, I have to find them. So what you can see is that the open interest will go down very quickly as expiry arrives. Okay, so we don't see it here yet. So here we are again in Bloomberg. So we have the open interest for the May contract. It's already it's still quite high, but when we arrive in April, you will see that the open interest here will go down radically. Okay, it will go down radically because actually people will cancel these contracts. They will buy the opposing position and cancel these contracts, and they don't want to have open interest when delivery expires, when the contract expires, because then they need to deliver. Maybe we can see it from another contract. The problem is here the first contract is some time away. So let's look at another contract. What contract could we look at? Soy. Okay. Let's look at the soybean contract. Okay. So the soybean contract. So it's again May. Delivery is again in May. So let's look at soybean maybe in another exchange. The same thing. Okay, I'll try to find out, but I mean, there are many situations where the open interest increases, and suddenly the last contract has a much smaller open interest, but because of this offsetting trades. Okay, good. What time is it? Soon time for a break. Okay, so what you can also do, but that's rare as well. So you can also take a contract off the futures exchange. So if you have a selling contract and you know somebody else who has a buying contract, okay, then you can actually directly talk. You can say, okay, we cancel our two contracts. Okay, I don't want to deliver. You don't want to buy. We just tear up our contracts. Okay, maybe we deliver, okay, before, maybe we deliver outside of the exchange, but if you have two opposing contracts from two parties that agree on not wanting to execute this contract, then you can also tell the futures exchange that you want to cancel the future contract. Okay, so that's important to understand, that indeed these contracts are almost never delivered. They are almost always offset by an opposing trade before they arrive at maturity. Okay. Okay, so now I have a bit of a text. Maybe we should have a break, okay? Because now we have just some information about, the important commodity exchanges and so on. Let me try to, okay. What does 15 mean in the margin calculation? Okay. Yes, I can briefly explain this again. If we go to our wheat contract, okay. Okay. You see the value of 1 point, okay? 1 point is 1 cent change in the price, okay, is $50, okay? Why is the value of 1 point $50? Because the price is quoted, remember, in cents per bushel, okay? So if the price changes by 1 point, it goes up from 1,057 to 1,058, okay? you have to pay 1 cent more per Bashel. Okay. Now you, when you buy one contract, you don't only pay one Bashel. The price is given per Bashel. Okay. But one contract corresponds to 5,000 Bashels. Okay. So 1 cent per Bashel corresponds to $50 per 5,000 Bashel. Okay. So that's where the 50 comes from. Okay. So every cent price change is actually going to generate a $50 value change for an entire contract consisting of 5,000 Bashel. Oh, is that clear? Okay. I hope whoever this question is still listening. Okay. Let's have a brief break. Need some coffee. You probably need some dinner. Okay. So let's come back, I would say in half an hour. Okay. And then we have another 2 hours of class. It's a quite long class. Okay. Let's have 30-minute. Okay. So sir. Okay. I'll switch off my screen. I leave the program on, but yeah, I switch off the camera and the microphone. Okay, but I will be back at um at 3 o'clock for me, whatever that is for you. Okay. Okay. See you in a minute. Okay, hello everybody. I hope you're all back again. Let me start where we stopped. So we went over the definition of contract. I tried to explain how contracts are created and then cancelled again most of the time, and only a very small fraction of contracts is taken to delivery. Of course, this is important that physical delivery is still possible. Otherwise, there is no guarantee that the price of a contract is connected in any way to the price of the commodity. And we will see that actually in many cases there can be disconnections between the real price of the underlying commodity and the futures contract, even at delivery, for a certain number of issues, but we come to this. Okay, so as I explained before, there's basically two things that are important. There is the exchange, so this is where these contracts are listed, and this is where you can find bid and asks. This is where you go when you buy a contract. And then you have the clearinghouse, which is the institution that looks at your margins and that settles day to day the losses and gains of everybody. So in the old times, and I think it's still the case for some institutions such as the London Metal Exchange, all of these companies were partnerships, some mutual companies, okay, non-profit making organizations. So you had the members who had a membership seat, and they were allowed to trade on this exchange, and everybody else who wanted to trade had to go through them, okay. And you could sell these membership stakes to other investors. But the purpose of the company was not to maximize the financial, not to maximize dividends. So the members would make profit on their own from being member and from being on the market. So over time we have seen a demutualization. So most of these mutual companies where the company is not supposed to make a profit have now been turned into for-profit companies, into normal stock quoted companies. The objective of who is to maximize the profit of the shareholders and not simply allow the members to trade profitably. Okay, so you can distinguish between three types of investors. You have the speculators, you have the hedgers, and you have the brokers. We have already talked a bit about this. So the speculators are the investors that have no link to the physical trading. They are neither producers nor users of the commodity, but they have very good understanding of the world. They have a good understanding of what Putin does. They have a good understanding of the current climate and how does it affect, different types of yields. So they can anticipate the prices better than the farmers maybe or the bakeries, okay? But they don't want to deliver or take delivery of the good, okay? So the speculation is, of course, for most people perceived to be a bad thing, but economists would often argue that speculation is a good thing, because speculation means that the information that is out there somewhere, okay, gets integrated in the price. And as we have discussed before, that will stimulate the production as needed as a function of the best available information. So I mean, again, the farmer doesn't need to know what Putin thinks. If a sufficient number of people speculate that know what Putin thinks, speculate on the wheat prices, the future price of wheat will go up, and that means that the farmers can start planting because they know that they will be paid a very high price in the future. Okay. And they don't need to think about the world, Putin, anything. That job is the job of the speculators. Okay, they can see the prices And if they see prices that they think are too low or too high, but they will because compared to what they know about the world, but they will try it, and the trading activity will mean that the information they have will enter the prices. The prices will move until the speculator thinks that now they have the correct price level, and of course that can again then be used as a signal by farmers or bakeries, and they don't have to know anything else. So the farmers and the bakeries, they are, in the terminology of economics, they are the hedgers. Okay, so they want to minimize their risk. They need to plan ahead. They need to plant. They need to seed. They need to maybe they have some contract where they have to deliver something on their own in a certain amount of time for a certain price. So they have to make sure that the raw materials do not change too much in price, because otherwise they will make losses on their own deliveries. Okay, so that's the hedgers. The hedgers always have a financial position, and they have a position in the underlying commodity market. And brokers, again, we talked about this. These are the financial intermediaries that carry out the deals. And often the brokers are also the members of this exchange, commodity exchange, where they have the seats, and they are the only ones that are allowed to basically trade on these exchanges, because otherwise there would be too many traders intervening, and it would be too complicated for the exchange to manage, at least historically. I mean, we talk in a minute about how trading actually works, and you will see that this has changed quite a bit recently. So which are the most important changes in the world? But if you look, actually, it's quite surprising. It fits to what we've just said before about the Asian markets becoming quite important. I'm just verifying that you can really see what I'm doing here. I think you can. Okay. The three biggest commodity derivative exchanges, futures exchanges, are all Chinese. So which one? So these three ones, okay, and that's a quite recent phenomenon. You can see that this is the Shanghai Commodity Index and the trading volume. So you can see that over the 2000s, almost nothing happened. Then you had a boom at the end of the 2000s, followed by a crash. But since then, you have a steady increase in the trading volumes, and that means that today the biggest commodity exchanges are Chinese. And actually, I had the names somewhere, but I don't know what happened. I seem to have wiped out the different names of these exchanges, but you probably know that better than me. The first three are Chinese exchanges. Then you have a Russian exchange, where obviously you have mostly oil contracts, and then you have the more classic US and European contracts. So you have the NYMEX that do stuff like coffee and softs. You have the CBOT, that is the wheat contract, the soybean contract. These are the contracts that we have seen. I didn't know that the Indian market is also quite high. And then you have the LME, the London Metal Exchange, and that's where you have the nickel contract. And you have ICE Futures, which is an electronic exchange that is a merger of a lot of other exchanges. Among others, the French derivative market has been absorbed there. And then the others are really small or smaller, but you still have some Chinese actors coming in here. Okay, so quite surprising, the massive dominance of Chinese markets today. I mean, that's not even today, that's 2019. Probably since then they have increased in importance. I mean, generally speaking, it's interesting to note that if you look at what type of futures were traded in the old days, so in the 1970s, you can see that, so that's for the US, but a similar evolution has happened elsewhere. You can see that 90% of the futures were agriculture, okay? And the remaining part is basically precious metal, okay? So agriculture and precious metal. You can see that in the 80s, and as time goes by, actually this what is the turquoise part is increasing constantly, okay, and the green part is increasing a little bit. What is this turquoise part? This is financial futures, okay. So since the 80s, the market for bond futures, stock index futures has grown tremendously, and it's today, I mean, it has continued to grow, is today the most dominant future market. So the mechanism is very similar to what we described here for the commodity markets, but this is a class about commodity futures and not about financial futures. So I won't talk too much about this, but you should know that today the most important futures markets are actually not commodity futures, but financial futures. Okay. So what are the economic functions of the futures market? We've basically already said this when we talked about the different participants. Okay. You have the hedgers, you have the speculators, and brokers that don't really have an economic function. Okay, and the key argument is, of course, that this allows producers to anticipate things, and this should actually, if the markets work well, it should, make price movements smaller. Okay. What is the idea? I mean, let's suppose that nobody, the farmers in Australia, let's say, okay, they have no idea what happens in Russia, okay, and they have no idea what the price at the end of September will be for wheat, okay. Now, if that's the case, you will see they will not increase the supply of wheat. So if they don't increase the supply of wheat, and suddenly everybody realizes that in September we have a shortage because Ukraine doesn't sell any wheat anymore, but then prices will spike. Okay, so the theory is that these kind of shortages are maybe not avoided, but are reduced. Exactly because the futures price can guide investors and can guide producers to increase the production. Okay, so today Australian farmers again don't know what's going to happen in September, but the speculators know that there will be a shortage, or with a very high likelihood a shortage, and they increase the price, and that means that the Australian farmers will start to plant more, and then of course if the Australian farmers plant more, that will decrease the price spike that might happen in the future when suddenly there's no wheat anymore. Okay, so normally these future markets have a very important economic function that allows to anticipate things and to increase production or decrease consumption depending on what's the factor, and smoothen out future price changes. Now it turns out that if you look at the statistics, that's unfortunately not how things work. Okay, there have been a lot of economic studies into, does the existence of a future market really lead to less price volatility for commodities? And it turns out that actually it's the opposite. Okay, it turns out that in a lot of cases, a commodity that has for which you have a future market has much more volatile prices than a commodity for which there is no future market. For example, onions, because it's forbidden. And the reason is what? The reason is exactly the kind of situations that we have seen for nickel again. The reason is that these future markets are often badly regulated, and then they don't function very well. And in the end, what you will have the financial investors drive the futures prices, and then the futures prices will drive the commodity prices. That's not how it was supposed to work. The idea is that demand and supply, and future demand and supply in the commodity drives the commodity prices, and then drives the futures prices. But there's today so much money in the markets that simply because investors either they just have herd behavior and they throw their money into certain markets for a reason that are not very rational, but that's going to increase prices, or they try to carry out sophisticated arbitrage operations that go wrong, such as in the case of the nickel market. And that creates price spikes. In some cases, actually, these price spikes are intentionally created by people that manipulate the market and that know that they can construct, they can generate very high profits with certain types of future manipulation. And that's a little bit what I wanted to talk about in the following minutes. Okay, so in principle, that is supposed to be taken care of by regulation. Okay, so the regulators know that there is a problem, that futures markets can make prices too volatile. Remember the onion market. So the onion farmers were extremely upset about this, and this was also based on manipulation. So in this case, they were forbidding the entire market, but actually in many cases, you just have increased regulation. So here you have a list of the US laws that regulate the future markets. It's maybe not necessary to get into detail, okay? But it's important to know the CFTC, okay, the Commodity Futures Trading Commission, which is the principal regulator for future markets, okay? And also for financial futures. Remember that the definition of commodities in the US includes, interest-paying bonds. Okay, that makes no sense whatsoever, but that's just how laws work in the US. Okay, so interest rate futures are supervised also by the CFTC. So the CFTC has an important role as a financial supervisor, not only for the commodity markets, but also for the wider markets. So, for example, the swap market and so on, this is also supervised by the CFTC. Okay, then you have different laws that regulate or deregulate the commodity future markets. Okay. For example, the Commodity Futures Modernization Act of 2000, CFMA, but this was part of the reasons for why Enron failed in 2001. Enron was an energy trader, and obviously as an energy trader, you do use a lot of futures trading, okay? And the CFM Act deregulated the regulations of energy trading and basically enabled Enron to take very high risk without anybody being aware of it. Okay. Now, as I think I told you already, that one of the surprising things is that the commodity future markets, there is no such thing as insider trading. Okay, so insider trading is allowed. So you can trade based on private information. Okay, why is that? Because these markets are supposed to integrate, as I explained before, the prices are supposed to reflect the available information. And I mean, if you don't allow informed farmers or informed, industrialists or spectators to trade on their information, but then you cannot expect that the prices you see are reliable, reliable reflection of the overall information in the market. Okay, and there's a famous example is Hillary Clinton's cattle trade. Okay, when she was young, she was a lawyer. Okay. Her husband, I think, was already the governor of Arkansas. She made an almost $100,000 profit from a $1,000 investment, okay, in cattle futures, okay. But it turns out that she was also the lawyer, okay, for Tyson Foods, which is a very big producer of cattle, okay. Normally, okay, these kind of gains would, of course, immediately lead to an insider trading inquiry if you make $100,000 from $1,000 of investment in a year, that's very suspicious, and normally you have the SEC trying to understand what's going on. Not in the cattle market, because again, the cattle market is there's no insider trading. Okay, so the regulation in detail is quite complicated. Because a lot of the participants in the commodity markets, they hate regulation, so they try to reduce it as much as possible. So you have 3 tiers of commodities. So the ones that are really important, that are strictly regulated. Then you have a second tier, which is almost not regulated, okay, and then you have the OTC contracts, okay. So this is actually the non-listed financial security, not commodity contracts that are only executed between institutional investors, okay. So no small farmers, okay. These are contracts that are designed to for very professional investors, and here you also do not have regulation. With the idea of that, I mean, these are sophisticated investors and they should be knowing what they are doing. So very complicated regulation, and repeated scandals. Okay, repeated scandals. I mean, this is just one example. Okay, the Red Kite insider trading scandal. Okay. Again, the London Metal Exchange is involved, the LME. Okay, what's the problem here? Red Kite is a hedge fund, okay, which was trading on copper futures. Okay, and if you want to trade on copper futures, remember, on the LME you have to go through a member or a broker. Okay, you cannot trade yourself. Okay, now of course, if you give your order to a broker, the broker knows what you want to do. And then they can front run your trade, so they can first, if they know that if you give them a very high buy order, but they can basically buy themselves and then execute your buy order, okay? And that, of course, this is called front running, and this leads to high profits for the broker. Because he will be able to, sell at a higher price to the hedge fund. And here, and normally it's of course forbidden because it's insider trading, because I mean the broker has information about future price movements and he's not supposed to use this. Again, in the commodity markets, it's much less obvious what is allowed and what is not allowed. So there is now some recent laws have come out, but really in the last 3-4 years, where to a certain extent insider trading is now supposed to be regulated, but the regulation is not as good as it is in the stock markets, for example. Okay, why? And one of the reasons of that is that in the commodity or more general in the futures markets, you have the regulator is quite weak, and you have a lot of tasks that are carried out by the NFA, which is the National Futures Association, which is actually a self-regulation by the industry. So that's a classic move that a lot of industries do in order to avoid too much government oversight. So they will create their own organization, and they will claim that this organization is carrying out the most important aspects of regulation. So the markets are self-regulated, and you don't need the government to come in and check what is happening. Okay, does this work? To a certain extent, maybe, but it is clear that these self-regulatory bodies are not very tough to their members. And I mean, there's a lot of scandals where actually it has been shown that the National Futures Association, okay, has not correctly examined brokers, though they supervise brokers, for example. Okay, and has allowed, for example, brokers to manipulate their accounts, these kind of things. So that, I mean, normally, a broker, normally you have a separation between client money and the broker's money. So if you invest, you want to buy a wheat future, then you wire your money to the broker, and then the broker will invest your money in the wheat future. Okay, so but this is your money, and it's in a separate account from the broker's money. Okay, in many cases, actually, the brokers have shifted, have basically stolen the client money and used it for their own purposes. All of these things should never have happened, but that's a part of the self-regulation problem. So the CFTC is a very high-level regulator. They basically supervise the NFA, and the NFA then supervises the brokers and the exchanges and the clearinghouses. And the exchanges and the clearinghouses also have, are supposed to be part of the regulatory system, because they also have to verify a lot of things so that the markets can function smoothly. So here you have a couple of rules that the broker has to look at. You have a couple of things that the future exchanges have to look at. So fraud, dishonorable conduct, okay, defaulting, and so on. That's the exchange that is looking into that. Then the broker is responsible for, know your client. They need to know where the money comes from. Okay. And they are supposed to make sure that everything the broker does, as the client does, is actually compatible with the CFTC's rules. But the CFTC doesn't verify itself these rules. So it's a complicated. It's a complicated system. Here you have some, Peregrine Financial Group and MF Global. These are two scandals where actually the brokers have mixed client money with their own money. Okay, but you can Google it if you're interested in financial scandals. Quite outrageous behavior by very high-ranking, investment bankers. So the reason, again, the probably insufficient regulation. Okay. And here you have the last layer, as I told you, the CFTC, the Commodity Futures and Commodity Futures and Trading Commission, which is the highest level of this complicated regulatory system. So what kind of, that's probably more interesting for you, okay, more interesting than the US regulation. But the US regulation is really in the commodities market in print is a benchmark for regulation in other countries. So commodity markets in the US are very old. They have existed since the 1870s. So they do have a lot of experience with what can go wrong, and the regulation there is indeed a model for other regulations. So what can go wrong? What can you do in in commodity markets to manipulate prices, for example? Well, lots of things. Okay, here's a list of abusive trading practices. We can just go over it. Okay, prearranged trading. So basically, you discuss with your counterparty, okay, about the price before you make an offer, okay, on the trading floor, or before you enter an offer in the electronic trading system. Okay, so that means that you can transact at the price which is maybe not the true price. Okay, you can tell your counterparty, okay, I want to sell at 100, you want to buy at 100, but actually I would like the price to show up at 80. Okay, so let's transact at 80. I give you 20 in private. Okay, but then the official price will be 80, but we will arrange a transaction at 100. Okay, so that can be useful in a certain circumstances when you don't want to influence the market price, or you want the other traders to believe that the market price is lower than it actually is. Pre-arranged trading, you can basically channel part of the price outside the exchange. Accommodating trading, more, I'm not sure what that is supposed to mean. Entering transaction, assist other floor participants in accomplishing improper trading operative. But that's a legal term, I guess. If you have somebody manipulating the prices, you can have other traders participating there. Front running, I've already told you. This is when you trade ahead of your own customer. Bucketing, that's interesting. Okay, so that's when a broker non-competitively takes the other side of a customer order to the detriment of a customer or the other members. Okay, so that means that basically you have a market that's not very liquid. Okay, you have a customer who wants to sell. You know that the price at which he is selling is a very low price. So what you do is you bucket the order, meaning you buy yourself. Okay, the broker, who's normally not supposed to be the counterparty. Broker is only supposed to, execute the order. Remember, because he's the only one who has access to the trading venue. But he can become the counterparty, and then, when he knows that prices are too good or too bad, he can become the counterparty and and pocket the profits. Wash trading, that's a very frequent thing in a lot of markets. Okay. Very efficient. So what is wash trading? By wash trading means that you have two related entities, okay, that just buy. One of them buys, the other one sells, okay, but essentially it's the same company. Okay, so you have two subsidiaries of the same company. One is selling, the other one is buying. Okay, that means that they can basically trade at any price. It doesn't matter because any profit or loss is ultimately in the same company, given that it's the subsidiaries of the same company. Okay, and that means, of course, that you can shift prices without a lot of problem in a lot of directions. Okay, you can increase prices simply by selling at higher and higher prices and buying at higher and higher prices. Okay. So of course, the part that is buying at higher and higher prices makes losses, but the part that's selling at higher prices makes gains, and overall it's going to offset. So wash trade is this practice of, it's similar to pre-arranged tradings, except that it's not, you don't have side payments, but you simply trade with yourself at some prices that you want to give. You want to give the impression that you have high prices. Okay. So that's wash trading. Has become quite famous recently. Okay, you may have heard about NFTs. Okay, these very strange internet things. I have no idea what it is. Okay, some kind of internet crypto art stuff. Okay, and you always read articles about these very high prices at which these NFTs are supposedly being sold. But it turns out that 99% of the trades in NFTs are between the same entity. Okay, so I create this strange internet thing, and then I basically sell it to myself at higher and higher prices. And then, of course, I have some stupid guys looking at these prices and saying, okay, oh, the price is going up like crazy. I think I have to buy one of these things too. When this guy wants to buy, then you will sell him. Okay, and now, okay, you can simply take his money, and you can give him your stupid internet stuff, whatever it is. It's not even something you can touch. Okay. And that is, of course, then going to be a net profit for you. Okay, it's a very simple rip-off, and a lot of people don't understand it because there's a hype around it. Okay, and frankly, the number of stupid people that have a lot of money is astounding. But wash trading is the strategy that these NFT creators use to give the appearance of very high prices and to draw in idiots that don't understand what's going on and who have the impression that what they see is an exponential price rise, and they have to invest money there. NFTs, wash trading, curb trading. So that's of course bad as well. So normally, as we've seen, the trading hours are restricted, and normally you're not supposed to trade outside the trading hours. But of course, that happens as well. Now, what is the time? Yes, so I've a couple of more examples. I mean, maybe one interesting example from last year. Okay. Or from No, it's from 2020. It's 2 years ago. This was big in the press. So we had actually at this time, this is long time ago, we had for a short term, we had negative oil prices. Okay, you can see that this is the oil price at the Chicago Board of Trade. Okay, and you can see that for a day or two, okay, oil was traded at prices of minus $40 per barrel. Okay, now we have more than $100 per barrel. Okay, now why is oil trading at this at negative prices? Okay, what does it mean? It means that actually you are paying somebody money so that he will take your oil. Okay, that's a negative price. Okay, why would that happen? There's one simple explanation, and then you have a more complicated explanation of how actually this arrived. Okay, but the simple explanation is that remember that if you take your contract to delivery, okay, let's suppose you're a buyer. Okay, if you're a buyer and you take your contract, the oil contract to delivery, okay, you have to be able to take the oil. Okay, now these big oil traders, they have of course storage facilities at in Cushing. Cushing again is one of these points where oil pipelines meet in the Oklahoma in the US. So if you buy an oil future and you don't offset it, then at some point you will have to, take your oil and put it in a storage facility in Cushing, Oklahoma. Okay. Now the problem was that at the time oil was so cheap that most people didn't even want to sell the oil. I mean, you can see that before here it was around, the price was around 38. I mean, these were good times. Right? Driving was cheap. Now, people didn't want to sell the oil, so people stored the oil in these storage facilities because they thought that it would increase. But now, of course, if you have a contract that says you have to buy more oil because you have bought a future contract that arrives at maturity and you don't know where to put it, okay, but then you have a problem. Okay, if you have no storage for this oil, but you're obliged legally to buy the oil, then what do? You cannot just spill the oil in the river. Okay, that's probably what you would do in many countries, but that would be a big problem in the US. So so you have to find somebody who is, either taking off this contract off your hands or taking the oil. Okay, and what happened here is that the financial buyers were so desperate to get rid of this obligation to buy oil because they had no idea where to put this oil, that they were basically paying people to take these contracts off their hands so that they would not have to buy this oil anymore. Okay, so and given that there were so few oil storage facilities, but they had to pay them $40 per barrel of oil delivered in a certain location. Okay, so that's an example of how the commodity market can make things worse and can actually increase the volatility of prices. Normally, you would not expect oil prices to go negative, but in commodity markets, all kinds of things can happen. So that's the simple explanation. Okay. So the more advanced explication is that I think we don't have. Okay, let's stick with the simple explanation. I think that's enough for today. But it was probably not a random event. I guess that's the key of the more complicated explanation. Okay, some people actually set up the entire game to benefit from this. It's a long squeeze, you would call it. Okay, and actually, Viga Capital, which was an oil trading firm, they made $500 million. Okay, on that day. Okay, because of these negative oil prices. So, and they probably, contributed to this problem. And there are some theories of how this works in detail. and it's about the end of day price and the within the day price. It's a complicated story, but I think for our purpose it's enough to know that this was probably an intentional manipulation of the oil price, and some people made a lot of money from it. Okay, good. Okay. Yes. Okay. And that's actually a pretty standard way of manipulating commodity markets. Okay, this is called a corner or a squeeze. Okay, and the classic corner is the Hunt Brothers Silver Corner. Okay, and that's an event that took place in the 70s in the silver market. Okay, late 70s. Okay, here you have the Hunt Brothers. Okay, these are two brothers that inherited a lot of money, and then they decided to corner the silver market. Okay, so here you have the price evolution of silver. Okay, the black line, okay, is the nominal dollar value, and then you have the inflation adjusted value. Okay, you can see that you have a massive price spike, massive price. So this is an exponential scale. See, okay, so you have silver was something like one, and in the 1960s, $1 per ounce. Okay, and it went up to something like $150 per ounce. Pretty impressive price increase. Okay, and the reason was only the manipulation of the Hunt brothers. So, and silver is of course a massive market. It's a big market, and you need a lot of money to manipulate the market. But they were able to do this. Okay, and the way they did this is very simple. Okay, they bought future contracts. Okay, they bought future contracts, and then they carried them to maturity. Okay, so they didn't allow them to be offset. And of course, if you don't offset these silver contracts, at some point, you buy the silver, somebody else is selling the silver. Okay, so at some point, you have speculators, traders. They had speculated on a decrease in the silver prices. Okay, but they didn't have any silver. Okay, so if you speculate at a decrease, okay, you sell silver contracts. Okay, which means that at some point, if nobody offsets these contracts, you have to deliver the silver. Okay, so the Hunt brothers, they bought all these silver contracts. Okay, and then they just waited until they were delivered. Okay, and these financial traders, they thought that they could offset these contracts, but they couldn't. Okay, so they had to find the silver, okay, to deliver it. Okay, or they had to offset at very high prices. Okay, so given that the Hunt brothers basically they had done this for a long time, so they had basically bought up all the physical silver that was available. Okay, and once they had done this, you can have a situation where you have a higher demand. So you have if you have a long contract in silver, you have somebody who needs to deliver you the silver. Okay, if there's no more physical silver in the market, but then the theoretical price of the silver can be very high, because if the short end, I mean the one who has agreed to deliver the silver, if they cannot find silver, then they go bankrupt. Okay, so that's the classic squeeze. Okay, you control the demand. Okay, you limit the supply, and at some point you have more demand through these future contracts than supply, and then you can get these extremely high price spikes. So in the case of the Hunt brothers, actually, they didn't make a lot of money from it because they missed a margin call. Okay, they missed a margin call, and then they had to remember they had these buy contracts. Okay, but then they had to sell these buy contracts. Okay, and when they started selling these buy contracts, okay, the silver price, these long contracts, the silver price crashed as well. So that's the classic example of price manipulation in these commodity markets, where you create an artificial demand by buying forward contracts or future contracts at a certain date, and then you just try to make sure that no physical commodity is available at this date, or at least not in the quantities at which you have, bought the futures contract. And when you have this situation, then prices can go anywhere because there's just not enough demand, not enough supply for fulfilling this demand coming from the futures contracts. Okay. Now, is that what happened in the LME? I don't think so. I think that's a slightly different situation because it was really not triggered by, a short squeeze. It was triggered by this price movement in the nickel prices because of the Russian war. But of course, the fact that this price movement leads to this massive price spike shows you that the market was not well regulated and that there was something wrong with the underlying market structure. But we've discussed about this already quite a bit. Now, let's talk about the last type of manipulation that I think is quite interesting because it plays on the difference between the physical price and so the spot price for actual delivery and the spot price for delivery in one of these warehouses, but where you actually cannot get the silver. Okay, so what's the problem here? Here you have, so this happened in aluminium, but it can happen with other commodities. Okay, so aluminium is traded as I told you. You have a certain number of warehouses where if you are carrying your short contract to maturity, you have to deliver the silver or the aluminium, and if you carry your long contract to maturity, you have to take it out of this warehouse. Okay, now you have these 5 warehouses worldwide. Okay, and what you can see here on this graph is actually the waiting time for you to get your aluminium out. What does that mean? Remember, when, let's suppose we buy future aluminium, okay, and then we get a delivery. We don't, the seller doesn't, deliver 10 tons of aluminium to our house. What will happen is he will give us the warehouse receipt. Okay, so he has deposited the aluminium in the warehouse. He gets a thing that says, I have deposited 10 tons of aluminium here. Whoever has this piece of paper can take it out again. So he gives you this piece of paper, but the problem is that when you go to the warehouse with this piece of paper, here is how much time you will have to wait before you get your aluminium. Okay, so look at that. Okay, so these 2 warehouses, okay, in Detroit and in Vlissingen in Germany, these 2 warehouses had a waiting time of 600 days, almost 2 years. Okay, so you think that you have locked in aluminium prices for the end of September. Okay, you get your warehouse receipt and you go to this warehouse in Germany and say, okay, I want to produce beer cans. Where is my aluminium? And they say, oh no, we have such a big backlog. We cannot give you your aluminium now. We will give you your aluminium in 2 years. Okay, now that is a big problem, of course, for the producer. It means that basically this aluminium is useless for him. He needs the aluminium now. Okay, what does it mean? It means that there is going to be a price difference between the aluminium that you can really get now and the aluminium that in theory should be getting now, but because there's so much waiting time in the warehouses, you will get only in 2 years. Okay, so investing in aluminium could attain 743 days. Okay, so what does it mean? It means that you get a price difference between the physical aluminium and these warehouse receipts. Normally the aluminium that you get in these warehouse receipts should have the same price, because normally you go there and you get your commodity on the same day. But here, for some reason, they overloaded these warehouses and you got it only in 2 years. Okay, so that's a big problem. Okay, it means that these markets don't work. And again, the question is, okay, was it intentional? Did somebody, So, I mean, the interesting thing is if you look at this graph, you can see that actually some of the warehouses had these huge queues and other warehouses were basically empty. Okay. Here you can get your aluminum directly. Okay. But the problem is that most people were delivering. I mean, these were empty, so it means that you cannot take delivery there. Okay, somebody has already put the aluminium in this warehouse. Okay, so you get. I mean, you cannot decide which one of these receipts you get. Okay, you get the receipt from the warehouse in which your seller has deposited it. And that means that the price difference, okay, there's going to be a huge price difference in the case of aluminum, up to 13%, okay, for the physical and immediate delivery compared to the delivery of these warehouse receipts. Okay, again, has it been constructed intentionally or not? There was a lawsuit. I think they didn't find anything, but it's a bit suspicious, okay, because these warehouses are owned by I mean, so that Vlissingen warehouse was run by Glencore. Remember Glencore? This was the firm that's originally created by the well-named Mark Rich. Okay. And the Detroit warehouse, the one that has also these very high queues, was owned by Goldman Sachs. Okay, and apparently they purposely, delayed the delivery. At least that are the allegations. Okay, and that means that you can actually get a big difference between the actual price and the physical and the futures price. So you get a disconnect, and that shouldn't happen. So here's the evolution of these premia. Okay, so the regulators started to look into this, and then these premia disappeared. Okay, so the premium of aluminium that you can actually get now, and the premium of aluminium that you're supposed to get now, but because of this warehouse problem, okay, you get a delay. Okay, so the problem was actually indeed related to an overproduction of aluminium. So here you have the total stock of aluminium at the London Metal Exchange, so in the different warehouses that belong to the London Metal Exchange, and you can see that you had a massive overproduction of aluminium. Okay, partially apparently linked to Chinese aluminium production, which was subsidized by very cheap coal energy. Okay, so when this overproduction stopped, and then the warehouses started to empty, then this problem also went away, and and today there's no physical premium anymore, or almost no physical premium anymore. Okay. What else do we have? Block trading, bunching, churning. Okay, dual trading, payment for order flow. Actually, this is stuff that is more relevant for shares than for commodities. So I'm not sure. We've already talked about a lot of misconduct. So that's maybe a stop here. Okay, so it's 4 o'clock. So normally we are supposed to catch up with another 15 minutes. The hour we have lost yesterday. But I propose that we do this on another day. Okay, so I have a nice natural stop now. We have finished our first handout. So I would say that we start with the second handout tomorrow, same time, same website. Okay, so let's stop for today, and let's meet tomorrow again. Okay, and prepare for some more WOO clubs for tomorrow. Okay, so have a nice evening, and bye. Okay, see you tomorrow.
You are currently the only person in this conference.